Something happened quietly over the last 72 hours that the mainstream crypto media is not connecting to XRP. And I want to address it directly. Because if you are holding XRP right now and you are confused about what you are seeing, the confusion is not a reflection of your analysis. It is a reflection of the fact that what is happening underneath the surface of this market is completely invisible to anyone watching the price alone. While every headline is focused on the geopolitical noise, while commentators are debating short-term price levels, something structural is occurring on XRP's exchange ledger that has historically preceded every significant price move in this asset's history. The number of XRP tokens sitting on centralized exchanges right now has dropped to levels this market has not seen in years. Not slightly, measurably, precisely. The data is on-chain and it is verifiable by anyone who knows where to look. What I'm about to show you is not being discussed the way it should be. Today, we pull back the curtain. Welcome back. This channel exists to cut through the emotional noise and find the structural signals that actually tell you where an asset is in its cycle. No hype, no panic, just data, pattern, and context. Today we are going to decode what exchange reserve drain data is telling us about XRP right now, and why. When you stack that signal alongside what institutions are actively building, the picture that emerges is one of the clearest this market has shown in years. Let's go. Let me start with the hard truth about how most retail investors read the XRP market. They look at the price chart. That is it. Price up, feeling good. Price down, feeling fear. And because the price chart is what is displayed on every exchange, every app, every financial media platform, that is the signal they treat as reality. Here is what they are missing. Price is a lagging indicator. It tells you what already happened. The leading indicators, the ones that tell you what is about to happen, live in the on-chain data. And specifically, one of the most powerful leading signals in crypto is exchange reserve data. It measures how many tokens of a given asset are sitting in wallets controlled by centralized exchanges, Coinbase, Binance, Kraken, and their equivalents. Why does this matter? Because when tokens are sitting on an exchange, they are available to be sold. They represent potential sell pressure. When tokens leave exchanges and move to private wallets, hardware wallets, institutional custodians, multi-signature vaults, they're being taken off the market. The owner is declaring through their action, not their words, that they are not planning to sell at current prices. They are holding, possibly for a long time. Now here is the critical piece that connects the exchange reserve data to the current moment. According to CryptoQuant's exchange reserve tracking, XRP's exchange holdings have been in a sustained downtrend. The supply available for sale at current market prices is measurably lower than it was 12 months ago, 18 months ago, 24 months ago. We are watching a slow, steady, persistent drain. And when you understand who is doing the draining, the picture changes completely. This is not retail investors moving their XRP to cold storage for safekeeping. The volumes, the wallet clustering, the transaction sizes, they point to something far more deliberate. On-chain forensic analysts who monitor wallet behavior patterns have identified transfer clusters consistent with institutional custodial onboarding. These are not individual investors getting nervous about exchange security. These are entities moving significant positions into custody infrastructure. The kind of infrastructure that Fidelity, Coinbase Custody, and others have been quietly building for years in preparation for exactly this moment. What you are watching on the exchange reserve chart is not random. It is positioning, and positioning at this scale, at this moment, tells a very specific story. Let me make this concrete with the math that the retail crowd consistently ignores, because the numbers here are not subtle. The cross-border payments market moves approximately $150 trillion annually. That is the global total of money crossing international borders, trade settlement, remittances, corporate treasury operations, sovereign fund transfers. The infrastructure currently handling that volume is the correspondent banking system, SWIFT, Nostro, and Vostro accounts, a network that requires approximately $27 trillion to be locked in pre-funded liquidity accounts at any given time just to keep the pipes flowing. $27 trillion. Sitting still, doing nothing, earning nothing, just waiting to be the bridge. Now ask yourself a simple question. If XRP is being positioned as a bridge asset, and not theoretically, but operationally, with Ripple's on-demand liquidity network live and running in over 60 markets right now, What does the math say about the price required for XRP to serve that function at scale? Here is the calculation. If XRP needs to bridge meaningful fractions of that $150 trillion annual flow, the market capitalization required to support that velocity without catastrophic slippage is not $50 billion. It is not $100 billion. At even 10% of global cross-border payment volume, $1.10, the market cap math demands a price per token that makes current levels look like a rounding error. Now layer in the supply reality. There are 100 billion XRP in existence. Fixed. That number will never increase. Of that 100 billion, approximately 55 to 57 billion are in circulation. The remainder is in Ripple's escrow, released at 1 billion per month, with a majority historically relocked due to market conditions. Of the circulating supply, what we just discussed is happening. Exchange reserves are draining. The liquid, available for sale supply is compressing at the exact moment that institutional infrastructure is being built to consume it. Think about what that means structurally. Demand is building from the institutional side. Supply available at current prices is contracting. The math of that equation does not require a prediction. It requires only a basic understanding of supply and demand. This isn't a Moonboy fantasy. It is the logical outcome of two converging lines that are moving in opposite directions simultaneously. And here is the final number that ties it together. The tokenization wave, the process of putting real-world assets, securities, real estate, commodities on blockchain rails, is estimated to represent a $4 trillion market in the near term. BlackRock alone launched its BUIDL tokenized money market fund. Franklin Templeton is moving in the same direction. Every single one of those tokenized assets needs a settlement layer, a bridge, a form of liquidity that moves faster and cheaper than the legacy system. The infrastructure being built is not being built in a vacuum. It is being built for a purpose. And XRP's ledger is one of the primary candidates for that settlement function. The math is not complicated. The numbers point in one direction. Here is where I want you to pay close attention, because the institutional validation happening around XRP right now is not speculative. It is documented and it is accelerating. Ripple's acquisition of Hidden Road, a prime brokerage firm that clears over $3 trillion in transactions annually, is not a vanity purchase. Prime brokerages exist to serve institutional clients, hedge funds, asset managers, banks. When Ripple acquires that infrastructure and integrates it with the XRP ledger, they are not building for retail. They are building for the entities that move capital at a scale that dwarfs the entire current crypto market cap. Ask yourself honestly, does a company building for retail acquire a prime brokerage that clears $3 trillion a year? The answer tells you everything about who the intended customer base actually is. Then there is the regulatory dimension, because institutions do not move without legal clarity. Fidelity's public letter to the SEC made clear that institutional custodians are ready, willing, and legally prepared to custody digital assets. The Digital Asset Clarity Act is working its way through the framework process that, when complete, will remove the single largest barrier to institutional allocation: regulatory uncertainty. The CFTC's commodity classification of XRP matters here in a way most people underestimate. Commodity classification means institutional compliance frameworks can treat XRP like gold or oil, not like an unregistered security. That is not a small distinction. That is the difference between a pension fund being legally permitted to allocate versus being legally prohibited from doing so. And then there is the statement from Larry Fink, CEO of BlackRock, the firm managing more capital than the GDP of Japan. When Fink publicly states that crypto is currently in the 1998 era of the internet, he is not making an offhand comment. That is a calibrated public statement from the man whose firm is actively building tokenization infrastructure, who has ETF exposure to digital assets, who understands exactly where institutional capital is positioned relative to where this technology is heading. 1998 was the year before the inflection, the year before mainstream adoption exploded. Fink is telling anyone paying attention where we are on the adoption curve. And while he is saying that, XRP's exchange reserves are draining and the weekly RSI is sitting at historic oversold territory. That is not coincidence. That is the setup. Let me be specific about what is coming, because the catalysts are not vague. They are identifiable and they are converging on a narrow window. The Digital Asset Clarity Act moves the regulatory framework from uncertainty to definition. When that process completes, the risk premium that institutional compliance officers have been charging on digital asset exposure gets reduced dramatically. The wait-and-see money becomes allocated money. That is not a slow trickle. That is a gate opening. The Basel III endgame provisions put pressure on the correspondent banking system's nostro vostro model in a way that has not been fully priced into the market's understanding of XRP's utility. Banks being forced to hold higher capital against those $27 trillion in locked liquidity accounts creates a financial incentive to find a more efficient bridge solution. Ripple has spent a decade building exactly that solution. The regulatory environment is now creating the business case that the technology alone could not force. And then there is the ETF dynamic. Spot Bitcoin ETF approval opened institutional allocation gates that have been closed for years. The XRP ETF applications currently under review represent the same structural unlock for a different asset, one with a fundamentally different utility profile, a commodity classification, and a live commercial network. When that gate opens, the entities that have been draining exchange reserves are not selling. They are waiting. The window for accumulating at current levels is not permanent. The catalysts have names, they have timelines, and they are approaching simultaneously. I want to be direct about what the exchange drain data means for the future availability of XRP at prices anywhere near where we are right now. When an institutional custodian takes delivery of a significant XRP position and moves it into cold storage or a multi-signature vault, that supply does not return to market for a 10% gain. It does not return for 50%. The entities doing this kind of positioning are not trading. They are allocating. There is a fundamental difference. Traders look for the exit. Allocators look for the infrastructure that makes their core business more profitable. Once those tokens enter institutional custody at scale, the liquid float, the XRP actually available for purchase on open markets, compresses sharply. The supply that retail investors and smaller institutional buyers will be competing for becomes a fraction of what is available today. We are moving methodically and measurably from an era of abundant accessible supply to a structural scarcity environment. The exchange reserve chart is not predicting that. It is documenting it in real time, right now. The question is not whether this supply compression will affect price discovery. The question is whether you understand it before it does. I know what it feels like to hold through the noise. I know the headlines are loud. The geopolitical escalation, the macro uncertainty, the red candles. They are designed, whether intentionally or not, to produce exactly one behavior in the retail investor: selling. The mechanism of every major accumulation cycle in financial history runs on the same fuel: fear, uncertainty, discomfort, the psychological cost of holding becoming greater for the emotional investor than the rational case for staying positioned. Being early feels exactly like being wrong, right up until the moment it does not. The on-chain data does not feel emotions. The institutional filings do not panic. The exchange reserve chart does not watch the news. It simply records what entities with significant capital are doing with their XRP. And what they are doing is removing it from the available pool, quietly, persistently, without press releases. The signal is clear. It has always been clearest at the moments when the noise is loudest. That is not a coincidence. That is the pattern. And the investors who recognize the pattern while standing inside the noise are the ones the market will reward when the structure becomes visible to everyone else. Let me close with what all of this data is actually saying when you put it together in one frame. Exchange reserves at multi-year lows. Weekly RSI at historic oversold territory. Institutional infrastructure being built in real time. Regulatory catalysts converging. The CEO of the largest asset manager on earth comparing crypto to 1998 internet. And a supply and demand math that points in one direction with no ambiguity. Price is not the signal. Price is the distraction. The signal is in the structure. And the structure, right now, is speaking clearly. The informed, patient, rational investor does not wait for the headlines to confirm what the on-chain data is already showing. By the time the confirmation arrives, the window has closed. Comment "drain" below if you are watching the structure and not the noise, because that tells me something about who is actually in this room. Stay calm. Stay positioned. The math doesn't lie, and the chain never sleeps. I will see you in the next one.